My name is Michael Guyot, publisher of the Lead Lag Report. A special guest for the hour is Katie Stockton, who I know many have seen on CNBC. We're going to have a nice deep dive conversation here. So, Katie, I'm going to give you a lot of credit. I think it was back in December I had you on a space, and you were one of the few that was making the argument that markets would start correcting, I think, mid-January, as I recall. And you were spot on.
Oh, good. I'm glad I said that.
And you were spot on in a lot of your analysis. So, first of all, Katie, for those who are not familiar with who you are, just set the stage for the audience about your background, your analytical skill set, and what do you do?
Hi, everyone. Thanks for joining today. I'm a technical analyst. So I have a company called Fairlead Strategies. I'm also the portfolio manager for the Fairlead Tactical Sector ETF, which is ticker ACK. And I started Fairlead in 2018, but I've been doing technical analysis for something close to 22, 23 years. And so it's really been a lifetime sort of passion for me in my career. And my methodology tends to be somewhat top down in its orientation, focused primarily US equities, but I do a little of everything. So I have an opinion on anything that influences equities. And we do a lot of bottom up work as well, meaning that we're looking for individual stock ideas, ways to express our top down views. And we do publish research for clients, both individuals and institutional investors, and we cover the S&P 500. That's probably what we're known best for, but we're looking at what we consider to be macro technicals also. So things like treasury bonds and gold and crude oil, the dollar. And our methodology, we're very oriented to technical indicators. So we're using gauges of momentum, oversold readings, and also relative strength to try to gain an understanding of the markets.
All right, so help the audience make the connection between being a technician and being a portfolio manager. So I didn't actually realize that you had launched an ETF until somebody told me about a month and a half ago. And I was looking at the holdings, and you've come out of the gate quite strong. But I feel like when it comes to technical analysis, there's very little attention that goes into how do you weight things, how do you come up with a broader thesis, and then maybe find investments that relate to that.
Yeah, I mean, that's definitely a challenge, because before this, I'd not ever been a portfolio manager, but I wholly believe and respect the fact that there's more to it than just technical analysis. And because of that, so over the years, we've been working a quantitative client to build sort of an add-on to their model. So we had developed some indicators and tools, and we morphed them into sort of a rules-based system. And in doing so, we felt we had something really compelling. And that was really the origin of, hey, well, maybe this is something that could actually be an investable product. And so that's the origin of it. And then it came from, just a lot of back testing on different variations of our technical models and the system that we built from it. And we found a real value, as I suspect, is in really putting a huge amount of weight on momentum, especially long-term price momentum in terms of our sector positioning. We focus on sectors mentioned in the ETF. We do the 500 sectors and discovered that if you're in the right sectors, it really truly is, to us, the key to outperformance. And we have ways to identify that are very much mathematical in nature. They don't require much subjectivity to them. And that's why it lends itself, I think, very well to sort of a rules-based system. And then beyond that, it's a matter of partnering with people that are smarter than we are and who can help us on, sort of the risk metric front, quantitative input, because I agree that, technical, I think, is really the ultimate complementary discipline. But there is more to investing than just using the charts. So we fully respect that and incorporate quantitative metrics as well in our positioning.
All right, let's talk about backtesting for a bit here, because this is a weird environment to find any kind of backtest or at least sample size that replicates it, right? Because while it looks like kind of standard run-of-the-mill type of correction, a lot of strange things, as you know, have been happening beneath the surface. Talk about how you view the current environment from a technical perspective, if there are other corollaries in history, maybe in the backtesting, that you see might be kind of helpful for the audience, because I think that this is really kind of uncharted territory.
Right. And I think we have to expect the unexpected from the markets these days. It's really, unusual price action that we've seen, undoubtedly, and that goes for day to day, it goes for week to week, and maybe even quarter to quarter. Unfortunately, we've seen a lot of volatility, and with volatility, you do get some moves that are more difficult to explain. Thankfully, with technical analysis, we do take some of the emotions out of it, and we can look at things in somewhat of a smooth manner, focusing on moving averages of price, for example, as the basis for many of the indicators that we use. And when you get the moving averages that are long-term in nature, flattening out or rolling over, it's a transition phase. And that's what the market's been through, as we all know. The 200-day moving average is just one case in point for the S&P 500 index has rolled over. And with that, we've seen basically a shift in trend and really a shift in market sentiment alongside that, as you know. So it creates a more difficult environment to take advantage of on the long side. So that's not lost on anyone. And then with this increased volatility and sort of the trading range activity that preceded it, I think it's one of the most difficult trading environments there possibly can be, especially those trading ranges that are characterized by volatility that I call it like time compression. Moves that used to take 2 months now seem to take 2 weeks or 2 days even. So it's really very challenging. And we do some indicate more short-term orientation. You have the risk of getting caught up in a lot of noise. So we use that time. Really, one of the approaches is to eliminate that. You can do that by using monthly indicators for one. Really just taking the month-end closing data and not fully eliminating the intra-month noise, because the indicators will absorb that, but definitely ignoring some of the daily price action that can be so confusing and emotionally charged. So I think that that's been part of our key in understanding how to navigate this environment best, is to really acknowledge the longer term indicators. And I'm quite sure that when we talked in December, that's probably what we addressed, because we became neutral longer term for the S&P 500 in our bias towards the end of last year. So I think it was in October that we started to see some signs of upside exhaustion that were long-term in nature. The market was still benefiting from positive seasonal influences, but of course those went away. And then the market was really released to move down, in our opinion. In terms of similar environment, as you mentioned, I mean, they all sort of rhyme, they don't repeat. So they're always different, with different characteristics. In terms of our indicators, we can liken it in part to about 2015 and 16. If you look at that environment, we had really a sort of a bear market cycle within the secular bull trend. And that's what we think we have at present as well. So we do think this is a bear market cycle, but we still believe in the secular bull, and that's based on things like the monthly cloud model. But in that 2015 to 16 period, we definitely had a move to what we consider to be sort of a risk-off environment. That was the best way to navigate that. Honestly, prior to that, I hate to say it, but we have to go back to the 2008 timeframe, and before that to the 2000 timeframe, to get to a place where our indicators somewhat aligned with how we look now. So that doesn't exactly make us feel better, but it's our closest comparison in terms of the risk-off positioning that's dictated by these indicators.
Okay, let's talk about risk-off positioning, because I think that's an interesting discussion, because treasuries have not acted as the risk-off safe haven play. And this is one of those weird environments where it's not about the signal being wrong, it's about the opportunity set, right? That, again, treasuries are not acting as historically they do. Now, if your opportunity set was utilities, staples, healthcare, right, you fared quite a bit better. I'm curious, what are some of the asset classes or sectors or sub-industries that you consider are risk-off plays?
That is the hard part, isn't it? Because it feels like sometimes there's no place to hide. And I think Q1 is a perfect example of that, as it pertains to the treasury market, where you just saw those downtrends extend themselves in an environment where they theoretically shouldn't do that. And that's, I guess, the risk of depending on historical correlations that we're all subject to. So sometimes it feels like nothing is working, and you have to either get creative, dig deeper, use option strategies. But what we're drawn to over time was a combination of safer haven assets, or at least those that are perceived as such, and that's gold, short-term treasuries, and long-term treasuries. So when you take the sort of risk off piece and diversify it, that can help mitigate some of the risk of these like anomalies that come up in the market by kind of spreading out that risk off exposure, not highly concentrating in gold, which would have been maybe okay or certainly better than treasuries, but still not great. But to have it spread across different sort of avenues of that kind of risk off position, to us is a good way to approach it. Nothing's perfect, but at least it helps minimize some drawdowns over time, we found. So that was our approach, is to diversify that risk off exposure among those three categories. Of course, there's always cash, right? And yet we have a lot of folks that really don't have the ability to go and just raise a bunch of cash in their portfolios, either because they're institutional investors that need to be invested, or it creates a taxable event and that doesn't make sense for them, that type of thing. So cash sometimes isn't a great option for them. And because of that, they tend to go traffic in things like inverse ETFs and things like that. And that can be really a difficult endeavor, in that the inverse ETFs, you're getting into market timing. And if you're not approaching systematically, that can be really difficult, just as difficult as investing in general in this kind of tape.
Market timing is an interesting term, because oftentimes the studies around market timing shows that market timing doesn't work because the alternative is cash, right? Cash is the risk off asset. And the problem there is that if you have these kind of successive false signals, you don't have a chance at compounding, no momentum. That's why you're better off actually putting some money at risk in so-called risk off assets. Talk about sentiment here for a bit, because I see a lot of people saying, oh, sentiment's bombed out, but then I see a lot of people saying, no, it can get a lot worse. From a technical perspective, what are the sentiment measures that you look at and that you find are most useful?
I love trying to keep tabs on market sentiment in multiple ways, and it almost goes along what we're just saying in terms of diversifying exposure. We almost like diversify what we look at to understand what we call some of the market internal measures, including sentiment. Another one would be breadth or market participation. So we're looking at multiple metrics of sentiment. One being the Fear and Greed Index, very popular tool that incorporates 7 different components that are somewhat transactional in their nature, in terms of trying to understand not just how people feel, but how are they positioning in the marketplace. So we'll consult that. It, like any indicator or input, it's not perfect, but it will give us a sense of how extreme of an environment we're in right now. And you might have noticed that we're extreme fear territory based on that Fear and Greed Index. This is as it pertains to U.S. equities. And I think the low was around 6% out of the scale of 0 to 100%. So you can see how extreme that is. Now we use that in a unique way where we're actually not looking for the oversold reading, but we like to see upturns and downturns for market timing purposes. And we also tend to focus on some of the investor polls. So for example, the AAII, or American Association of Individual Investor Data, can be somewhat informational. That's gauging people's sort of temperament towards the market. We also like to talk to certain people that have certain approaches to the market and get a sense of sentiment just anecdotally through our conversations. More recently, we feel that while these metrics that are more transactional in nature, they're leaning more oversold or fearful, that we don't really sense that in our conversations or in the inquiries that we're getting from our client base. So we sense that folks are out there looking for the buying opportunity, as opposed to being nervous about what happens beyond the near term. So our conversations don't suggest there's a lot of fear. And yet, some of the transactional gauges do. One transactional gauge that's a component in greed is CBOE volatility index. It looks at puts and calls and their premiums and tries to understand, again, how people are positioning and trying to understand the next directional move of the S&P 500. The VIX holds an inverse correlation typically. We won't rely on it, but typically to the S&P 500. So we find that there's some value in that. We like to apply our indicators to the VIX as well and try to understand levels that might have importance as support, resistance, et cetera.
At what point do you think this breadth is going to improve in a sustainable way, right? Because it's been pretty bad really since February of last year. And I know a lot of technicians look at breadth as a sign of a healthy market. But every time it seems like you try to catch the the bottom and looks like breadth might turn up, it doesn't. So I'm curious your thoughts on how people should look at breadth and what would make the marker for a turning point, so to speak.
Yeah, so breadth is another one, right, that we like to look at multiple inputs for it. And it was really neat. I just had Tom DeMark on a webinar with our customers, and he showed a signal that was kind of interesting on one of the breadth measures as an oversold indication. And I kind of see the same types of signals and measures like the percentage of stocks above their 200-day moving averages. Things like that are pretty oversold and oversold not just short term, but intermediate term. So there are those indications, but we don't like to really be too early in terms of a breadth turnaround. So we'd prefer to wait for actual breakout or, even just a move simply above a 50-day moving average and to affirm oversold conditions are ready to give way to some kind of breath round. You can see with just about 20 NYSE, their 200-day moving averages, the down move has been really broad based. And I think that that's something that, again, it emphasizes why it's so difficult to take advantage of this market on the upside when you have such broad participation on the downside. So we previously had gotten accustomed to upside leadership from the mega caps. And that was the big shift in the last few months where we lost the leadership from the FANG plus M plus T stocks. And that's become really pronounced of late with Apple and Tesla finally following the others below on their chart. So that bode well. So breadth improved. We can actually see a market that still struggles because some of the mega caps are actually just breaking down, whereas some of the higher growth players are actually pretty deeply oversold at this point, and maybe even the worst is over for some of them just because of how they set up on their monthly charts. It's not to say they look like great entries here. When you see the downside, it seems like it might be contained relative to what we could get from some of the larger cap names out there.
I got to imagine that would be kind of hard, though, right? Because, yes, you can have large caps catch down to everything else, but I find it hard to believe that if large caps break down even further, that small caps, for example, could buck the trend and actually be green, right? So how do you think the co-movement could play out if, to your point, these large caps are just starting to break down, but all these other areas have been broken for a while?
Yeah, no, that's a great point, and I struggle with the same because I can't go out and feel comfortable recommending a stock that's in a proper downtrend still without any kind of base in this environment. But when I think of it more in relative strength terms. So we do a lot of relative strength work as it pertains to sectors, of course, but also individual stocks and segments of the market. So we'll often look at not just what something looks like on the surface, just in terms of their price trends, but also as a ratio versus the S&P 500. And if you look at something like the ARK-K fund, which I think is a good proxy for the high growth names out there, it's been in a downtrend, a pretty significant downtrend since early last year. And there's been, some short-term phases of outperformance within that context. And arguably we're seeing one of those pretty much right now. And yet what we'd be more comfortable with is once that relative strength ratio really turns in earnest, that's where we could build relative exposure or at least become perhaps less hedged in that environment. So it's not a matter of saying, okay, we're going to run out and buy these names in a weaker tape, but rather, maybe start to just change our paradigm as we evaluate them and say, instead of looking for selling opportunities, now I'm going to go into the mode of looking for buying opportunities, even if it doesn't have to happen tomorrow. So I think it's more about changing your paradigm in terms of how you think about them, but awaiting that real turnaround in relative strength before feeling like you can assert a real position and overweight exposure.
But there's a duration component to that, right? Meaning if some sector has led for a long period of time, there might be nervousness at maybe chasing something which has already outperformed for a while. So I'll give you an example. Utilities, the Dow ward, right? Utilities historically, they tend to, in short bursts, outperform in advance of major high volatility events, crashes, corrections, bear markets. However, if utilities have outperformed for the last 6 months, they end up being a contrarian signal for a bullish move, right? So short term, it's a signal for corrections, volatility. Intermediate term, more of a a mean reversion component to utilities as a signal. So talk about from the studies that you've done, is there sort of an element of how long a sector can lead that makes you maybe want to shy away from it if it's still showing up on your screen to maybe scale down a little bit?
So we don't think of it, I guess, as like historically speaking in that way. We really are respectful of momentum gauges. Our work doesn't tend to be ultra predictive, but rather we're just trying to stay on the right side of trends of utilities. The uptrend is still very much in force, but as soon as it loses that momentum, we'll just kick it out. As soon as we feel like it's lost enough momentum to dictate that. So rather than be dependent on the historical cycles for utilities, we're a little bit more crude in how we're approaching it to say that as soon as that momentum falters, whatever the reason may be, we'll feel like there's probably a better place to park our money. But certainly that's been a great trend, to take advantage of. And I fully know that things can't, sustain this kind of steep up move in relative terms in the way that utilities have done. So we suspect it will reverse. We just don't have any feeling as to when that's going to happen. We can try to reconcile it with our longer term indicators as it pertains to the S&P 500. And those indicators give us a sense that the bear market cycle could keep hold for another few months, interrupted even by strong relief rallies at time. But over the course of those few months, we think that utilities would probably maintain, maybe it's not this steep of an uptrend, but some kind of uptrend in relative strength terms. So looking at something like XLU divided by the S&P 500, that's how we think about it.
Yeah, no, that makes sense. Okay. I'm curious, Katie, what do you think is more important for equity investors, the Fed or commodity prices? And I say that because really what I'm hitting on is demand destruction versus supply constraints. And I know that's outside the realm of technical analysis, but I have to assume that's part of a consideration, at least in terms of how do you frame a way of looking at the current environment.
Yeah, I mean, listen, like you've cited two sort of major concerns, and they're often concerns. So they're not new concerns. What I always worry about more is the unknown, and the unknown is never the Fed, certainly. So I would think that maybe it's more related to commodities, inflation, than it is specifically the Fed. But they're both concerns in terms of how quickly they're going to move. And, we're already seeing a reaction from the market that we're all pretty uncomfortable with. So I think we've definitely been shaken in how we're thinking about all of that. And yet, thank goodness for the commodities to present something in the marketplace that is working, that we can take advantage of on the upside. So it's one of the few places that we have uptrends to take advantage of. And so we're exposed to the energy sector in the TAC fund for one. We also see some signs of strength in other commodities that, we look at outside of crude oil and natural gas. We are more bullish on gold right now in terms of having pulled back to some support on its chart. So we're just grateful for that asset class to provide us something, that is trending higher in this type of environment, which of course is very tough for US equities. And reasonably so. We would never argue against any of the macro risks that are widely cited out there. It's not really our expertise, and we do consume a lot of it like you do. But we really, first and foremost, will just respect the price action and make sure that we try to get ahead of it and manage risk accordingly.
Okay, so let's focus on managing risk for a bit. I would argue managing risk is a lot more challenging in a bear market. Because if somebody's idea of managing risk, for example, is to put a stop order, well, in bear markets get more volatile. So you're more likely to have that stop order hit and, maybe get whipsawed because of that. Talk about some of the characteristics that you've seen of bear markets and how people should manage that higher average volatility versus, kind of a more classic bull market.
It's a great question. And we struggle with the stop loss placement a lot because, like you said, there's a lot of volatility in this tape. In fact, we have an open idea out on our Substack newsletter that we were just kicking around. Do we want to tighten up the stop to preserve some of these gains? And therein manage risk, of course. And we said, okay, but we tightened it up a lot less, I'd say, than we normally would have in a stronger tape, because we just know that the market's capable of anything, especially on a day-to-day basis. And we don't want to get whipsawed. We don't want to get sort of shaken out as a weak holder of that security. So we really are conflicted on stop loss placement every time we establish that. What I use as a discipline, and it's good for us. I don't know that it's good for everyone. Is that we wait for two closes below a level, and that helps eliminate at least some of those shakeouts or whipsaws, and helps you navigate the risk as well inherent to the market right now. So we use just a like a sort of a time and price filter for 2 days, not just one, and that's helped a little bit in terms of not getting whipsawed. But it's a little bit of a more difficult thing to impart to investors. It's more difficult to track because you can't just place a stop loss order per se at a certain level. So it requires more maintenance, but it's something that we think is somewhat important in this environment as a risk management tool, is to be able to add a little bit of subjectivity in those stop losses being. So that's certainly one way to do it, but there's numerous ways to manage risk. I mean, we talked about the alternative asset classes, also options, and different strategies can get very sophisticated. And then of course there's the volatility products, so ETFs that represent the VIX, which has an inverse correlation, and other ETFs that give you that inverse exposure can be used as well to hedge existing long exposure. So there's a lot of ways to manage risk, and other people would just raise cash, but those stop losses can, definitely get hit more than average. So I just think it's a matter of adapting to that. And maybe there's an easy way to do it by just saying, okay, well, when, X moving average is pointing lower, I'm going to give a little bit more room to my stop losses. I know we all are looking for that, right? And self-servingly, I would recommend looking at TAC ETF, just because it does get you the large cap US equity exposure. So that's the primary focus of it, is to be leveraged to the momentum behind the sectors in the market that are working. Large cap and focus. So that's something that I'm comfortable with as well. But then it has the automatic sort of risk off piece to it. So the design of that is to minimize drawdowns. So when the market's doing what it's doing now, then you have that ability to, outperform in these types of volatile environments. Since tax inception, it's done very well versus the S&P 500, and it gives you a bit of a safety net. And I would argue technical analysis kind of does that in general. So that would be, sort of a first recommendation. Otherwise, I would consider sort of a balanced exposure to alternative asset classes. So gold, short-term treasuries, long-term treasuries. I'd have some level of maybe defensive sector exposure, but only where you have conviction, if you know the companies, and then a bigger cash component than you're probably accustomed to over recent history. That's how I would think about it. I am not an investment advisor of that nature. I'm more of a technical analyst, but that's how I'm thinking through the markets right now in terms of an intermediate term time horizon. I like the way you phrase that. And thanks for attending other webinars. I appreciate that. But so listen, there is no such thing as a bad environment for technical analysis. Technical analysis works no matter, whatever our input is. It's really just analysis of supply and demand. But then, of course, you have user error, is the way I would put it, where folks that it's really in how we're applying the discipline that sometimes the discipline fails us. So it's really a human interaction with technical analysis that sometimes makes it get a bad name. So there is no bad environment for it. And in fact, I would note that when the market goes down or volatility goes up, so does the demand for technical analysis. And I think it's when the markets are more top down in their orientation. So when you see the S&P 500 move or a sector move really influence just about any stock, no matter how fundamentally strong they are, those are the times at which it is really important to have a sense of levels for the S&P 500 and momentum over different time horizons. And all of that, I think, is important all the time, but most important when you have this volatility that is top down in its orientation. So to your point, if you think earnings are really going to improve and there will be a shift back to, folks seeing this as a big buying opportunity, and certainly, listen, we wouldn't rule out any of that. If that's the case, well, then it should move it back into more of a bottom up oriented market. So it should become less top down in its orientation. And that would allow us to, have more success in terms of stock picking. The stock picking really hasn't been rewarded in this environment, but in that environment, it usually is more so. So we would make sure on our end, what we would do, we would make sure to just be in the right sectors and find good setups in good sectors. That's how we try to navigate that. But it's important to what tends to happen when you get these big downdrafts in the market. Folks are way too late to get the confidence to get back on board with it, and that's why I think technicals are so important because they can help you without emotion understand where momentum has shifted again to the upside in a meaningful way. And that was especially helpful at the COVID corrective low in early 2020. That was something that was really shook everyone's confidence and it was very difficult to feel like you could just get back in fully to the market. And a lot of people like really miss a lot of that move, not getting in for several months or even in some cases years, just based on our conversation. So it's a matter of being willing to kind of shake off that sentiment hiccup that we all had lived through and be willing to respect the momentum shifts and using the long-term gauges to do that, making sure that it's not some kind of head fake in terms of just a relief rally that will be a failed relief rally, but rather something that has a higher probability of lasting longer. So, and by following those momentum gauges, you're not going to buy right at the low. You won't be there for that first day, first week necessarily off of an important low, but you'll certainly have better luck at trafficking in the primary trend, right? And so that's what we use. We use technical indicators to understand when the markets really turn the corner again. And we don't have that yet, but we're always going to look out for it. We have, just opinions based on our indicators alone. And so when the indicators turn, we'll certainly turn with it. And we would suspect that's probably not going to be for a few months. I think in some cases it probably does, not in like a measurable fashion. Where I feel like I see that sometimes is with the DeMark indicators for one. So as you know, I'm a big fan of Tom DeMark, and some of his indicators have a lot of eyes on them. So I sense that sometimes when somebody's watching for a buy signal and you see one, it becomes somewhat especially on the individual stock level where let's say there's a trading desk at a big wirehouse and they see these signals too, and they got vocal with all of their clients. Well, all of a sudden you have sort of a big institutional audience for this signal. So I think at times you'll see something like that, and otherwise it would be important levels, as you mentioned. Things like the 200-day moving average, which is really widely followed here. You will sometimes see like a little bit of a flurry of activity around some of these widely watched levels, especially moving averages. And that of course is somewhat self-fulfilling as an important level, right? Because there are so many eyes, and those eyes can be real people, or they can actually be computers that are programming these levels as well. So some element of it not easily measured, but that's all the more reason, in my opinion, to have the charts and the levels on your radar. Yeah, sure. So oversold positions are not always a good thing. we learned that the hard way, right? So we do spend a lot of time trying to gauge these oversold conditions, but then also we make sure that there is a little bit of an uptick in momentum before feeling like those oversold conditions are actionable. So we like our preferred ways of understanding whether something's oversold are usually using the stochastic oscillator or the DeMark indicators. And then we'll use something like a moving average based tool to see if there's any kind of uptick in momentum that seems meaningful. And that's our way of navigating through that. But as you know, an oversold condition and a bear market move is going to be lower probability than in an uptrending market. So there's ways to kind of nuance what you're looking at by understanding what the current environment is, up down. We definitely give a lot of weight to that. And then, of course, we can have a better understanding of these moves and the likes of Snap. I'd also make sure to consider the time horizon. So if you had, say, Snap, an intermediate term oversold reading from a weekly indicator, which we do have, well, that doesn't comment on a day of price action. So it's a matter of making sure that if you're talking about a short-term move, well, then you're looking at the daily indicators or intraday indicators. But if you're talking about, a sustained relief rally from intermediate term oversold, well, that doesn't happen necessarily the next day or even the day after that. but you should start to see it unfold, within the next week, perhaps. So I think it's just a matter of making sure that you're not confusing time horizons with, like, if you see an oversold on a 60-minute, well, that's great for the next few hours, but it's pretty meaningless as it pertains to anything more than that. So just making sure that you have attention towards that.
What's interesting, Katie, is that the two major asset classes most people have their money at risk in, which is stocks and bonds, are arguably both oversold. We haven't talked about bonds too much or at all here. It's my belief that bonds are probably a better risk-adjusted trade than stocks. Could be wrong. But how do you think about the bond market here, the sell-off, the correlation equities? I keep making this point. They wanted a yield when there was none. Now they don't want any yield when there is some.
Yeah. And I mean, we've seen outperformance from treasury bonds since about mid-April, I would say, versus the S&P 500. So there has been somewhat meaningful rotation in relative terms, but it doesn't look like much yet in absolute terms. They are both sold by sort of measures, intermediate term at least, and yet they're different. They're coming from different places. Where if you look at a treasury benchmark like a TLT, which is pretty popular as an ETF representing long-term treasuries, TLT has been in a downtrend for a long time. So you could say it peaked in early 2020 and then had basically a counter trend move for much of 2021 and then resumed its downtrend. Now, we have a way of trying to understand what the projected level from the breakdowns that we see are. Like when we saw the breakdown at the start of this year or earlier this year below the 2021 low by TLT and similar benchmarks, we could project using just a measured move projection, which kind of assumes the trajectory of the current trend will sustain itself. And it got to about where it bottomed. So it got to that, let's call it the targeted level from the latest breakdown was already met. So we do give weight to some of these levels as holding some importance. And when a targeted or measured level is reached, well, to us, that suggests that it got a better chance of at least stabilizing, at least getting some kind of counter trend price action. So that's what we think we're in the midst of, is that stabilization in treasury bonds and consolidation in treasury yields. Very natural place for that to happen because you had in the 10-year treasury yields that came right up against the resistance from 2018. So sort of a psychological hurdle for them. And it was a natural place to see what we're already seeing. So it was really just attention to the important support. And then for yields resistance levels, that came in line. Whereas for the equity market, it's just a different trend. It's not a prolonged downtrend in the way that we have in the treasury market.
But in fairness, that's obviously talking about treasuries, but what about corporate credit risk bonds, right? So I keep making this point also that spreads yields have not, in terms of junk debt issuances, really blown out relative to treasuries, duration adjusted. How do you think about credit risk bonds at this point?
Yeah, I mean, it's not really our area of focus, but we focus typically just for certain clients on benchmarks like HYG for high yield bonds or JNK. So we're kind of surface level in the way we look at these things, and not at all macro focused. But those downtrends are equally kind of at targeted support. As an example, we have nearly like a 61.8% retracement, which is a Fibonacci retracement level of the uptrend off of the 2020 low for HYG. So we try to have a focus on certain levels, and then around those levels, we look for some reaction in terms of momentum to the signals that we're getting. So we'll look for the oversold reading near support. That's kind of step one. And then we look for those upticks in our momentum based or moving average based gauges to understand if that oversold condition is having some kind of impact. And we're seeing the very, very early stages of that with the recent outperformance versus the equity market. So we're compelled by that. It's still a proper downtrend. and listen, this goes back to like it feels sometimes like there's no great alternatives in the marketplace. So, if we're recommending stocks or any kind of fixed income benchmark into downtrends, it's in part because we have no other great choices necessarily. So we're just trying to capture some counter trend moves here.
So speaking of counter trend moves, and maybe this kind of dovetails a little bit with sentiment, I don't recall ever seeing any space on markets the last 4 months that does not mention oil and the commodity bull market. And obviously that's worked to your point, but I do wonder if the sentiment there has gotten extreme in terms of the belief that these are going to keep going vertical, and maybe they will. But how do you think about sentiment from a sector perspective? Right, we talked about it from a broader market perspective, but from a sector perspective, when you that's mostly anecdotal, right? But are there any measures that you look at that can maybe give you a sense of some kind of extreme bullishness in a particular group?
Well, not in particular in terms of market internal measures. I don't have good specific ones for the individual sectors, but I mean, you can almost just see it in the returns, right? If you look, it's just wild because we can draw, of course, energy back to the action in crude oil prices. In part, the energy sector, I just pulled it up as of right now, is up 50% year to date. And the next runner up is utilities at 1%. So okay, there you have it, right? In terms of sentiment extremes. And who's to say 30% or 50% is extreme? So there's grades of how extreme it can get, I guess. But we see that as a reason to manage risk, right? In terms of understanding the momentum gauges. So to navigate that, we do in our research, we'll refine what we're looking at to be a bit more short term in its orientation, because when something's run up as fast and furiously as that, 50% year to date, well, we'll be like even more sensitive to any downtick in momentum, perhaps, than we would be otherwise. We'd be maybe a little bit forgiving for something that isn't quite as overextended in its appearance. But you can see we're just still respectful of momentum above all, and the crude oil still has it, and yet there's definitely a loss of momentum versus earlier this year, but it still has maintained even positive intermediate term momentum. And in the search for things that are trending higher, it certainly fits the bill. Still, there's some modest signs of upside exhaustion on the long-term charts, but nothing really impacting our shorter-term gauges yet. So it's just something that we have an eye on, and we'll be very, very sensitive to any downtick in momentum that's associated with overbought conditions. You'd be surprised, though, crude oil, as much as we've seen that run up in the energy stocks, crude oil is not even overbought right now on our weekly gauges. So it's somewhat overbought longer term, but intermediate term, it appears to still have some room for follow through. And that may be completely unrelated to what we would consider to be a normal supply demand dynamic. It could be more of a geopolitical comment. So, but the charts won't tell you why something's happening. They'll just kind of tell you what's happening. Yeah. And so it goes back to the long-term pitch where we think that it's a second bull market still, but it's unrelated to money flows and what you're citing. It's related to one of our very long-term indicators, which is the monthly cloud model, which was actually tested successfully last in March of 2020. And so we do
maybe talk about that, because you mentioned that before, Katie. Just for the audience, what exactly is that?
So it's a Japanese indicator, and it's actually has a Japanese name. It's Ichimoku, but I'm probably axing the pronunciation there. But the design of the indicator is to create sort of one look at the primary trend and all potential future support and resistance. And it's really been very helpful to us over the years as a gauge of support and resistance, and the primary long-term trend, which it does show is still higher for the S&P 500. But the catch is, George, to your point, that there's a lot of room right now to that cloud. So it does give you a sense that there's still some risk. The cloud moves higher pretty quickly over time. So I'll give you an example. The S&P 500, the cloud is presently about 2,800 at its upper boundary. But if we go out to, let's say, this time next year, we're talking about looks just shy of 3,500. So it depends on whether this ends up being sort of a slow grind lower, or does it really need that kind of flush out type of activity? You can't rule anything out, of course. We like I said, don't super predict. We're just trying to put the trends on our side. The case scenario that I've been considering in my work is a 61.8% retracement of the uptrend that began off that March 2020 low. And that would be roughly 3,200. So at a certain point, that of course meets up with that monthly cloud. So it's a matter of combining the levels with sort of the duration at which they're tested or reached. So there's a lot of inputs. You can't rule anything out. There is an uncomfortable room to both the monthly cloud, certainly at this time, and also those retracement levels. So I think managing risk is very important here, and we have been telling our clients the same. But also the our day job, right? So we tend to also focus on short-term swings within that context, and so we're trying to either help people time exits if they have what we consider to be the exposure that looks vulnerable. And by vulnerable for us, that means something that's going to break down, taking out an important support level. So we'll try to help folks time entries and exits sort of with that in mind and make sure that they're getting the most out of their market hedges in this kind of environment.
I'm curious, Katie, what do you think most people get wrong about technical analysis? Because I feel like a lot of people just think that if they look at a chart, they're suddenly a master technician.
I think the biggest thing is not approaching it systematically. And I just in my experience, I find that there's very little pushback on the discipline anymore. I think 20 plus years ago, there's certainly an image of it not having validity for whatever reasons. And I think we've gotten past that, certainly. So I think what's happening for some of the audience for technical analysis, they like it, they understand it, they want to employ it, but they're consuming a lot of information, right? They're getting information from every direction, a lot of which is technical. I mean, you don't have to go very far to find technical analysis on Twitter or anywhere else. And so what I think can happen there is you can get almost information overload and not know what to do about it. So I think it's a matter of coming back to the same methodology or the same source of analysis and trying to understand it and realize that there is no one indicator that has all the answers, right? But if you actually have a process and you're going back to the same methodology, I think that's where folks can get it right, at least. So I can't tell you, stories about people getting it wrong that way, but I sense that could be happening because there is information overload and it's all interesting. But what do we do with it when one person thinks Apple is breaking down, the next person thinks it's majorly oversold with a buying opportunity? What do you do with that information? The way to really sort of hone in on the usefulness of the discipline is by employing it in a systematic way. So that would be my short answer for that.
Yeah, no, completely agree with that. Okay, so last direction on my end, and again, everybody that's here, please make sure you follow Katie Stockton and check out TAC as well. Let's talk about currencies here. A lot of people seem to be under the impression that the dollar's about to now do an about face. Maybe not, but let's talk about the dollar here, because I think that's been one of the more perplexing parts of the way the broader risk asset landscape has behaved here.
Yeah, and I mean, wow, quite a trend, right? And it still has the support of the intermediate and long-term moving averages. So supporting dollar strength. Primarily, I'm using the dollar index often as my proxy, which is largely euro in its exposure. So the trend is still favoring a stronger dollar longer term. But then within that context, we have seen a meaningful downtick in short-term momentum. You could see it in something as simple as the 20-day moving average. So it is a downtick in momentum. That's really the most meaningful that we've seen since we came out of the consolidation. And so we're being mindful of that. At the same time, there's some signs of upside exhaustion intermediate term from the DeMark indicators. And this is coming at a time when, if you look back over history, there's long-term resistance for the dollar index back at the 2016-17 highs, not far from current levels. So we saw what we consider to be an unsuccessful test of that long-term resistance. So this would be a natural place for these gains of late for the dollar to be digested, we call it, meaning sideways to lower price action for the dollar as it digests that overbought condition near resistance. We would assume that after the consolidation phase, sort of runs its course and does what it's designed to do, which is to relieve an overbought condition, then that we would emerge to the upside from that.
Special thanks to Katie Stockton. Katie, what's your website? How do people find you?
Thanks, Michael. Yeah, and thanks for hosting me today. I always appreciate that. So our firm's website is fairleadstrategies.com, and the fund's website is fairleadfunds.com.
Everybody enjoy the rest of your day.